Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 10th of September 2025. I'm Mark Gardner. So very much a good news, bad news for this morning's morning call. So I'll start with the bad news. Everyone usually likes to start with the bad news. US jobs or payrolls numbers were revised down 911,000 jobs for the last 12 months. That's the largest drop in history, bigger than the revisions back in 2008 into the GFC. And yeah, just absolutely horrific. So I've been sort of mocked a little bit for saying we haven't had a negative payrolls number since December for about the last 6 months. But as it turns out, we have been having negative payrolls numbers. The BLS are just not put the figures together properly. It's so large, it's been met with skepticism. And Goldman Sachs made note that, many estimates may undercount unauthorised immigrants, but why are they in the numbers anyway? But, okay, flipping over to the other side, the good news, Oracle reported earnings after the bell and rallied. It'll be their best day in decades, if not ever, of single-day jump. So this is aftermarket, so it's got to maintain these gains in tomorrow's session, but up 27% at one stage. And look, for any of you that watched our hyperscaling AI webinar, this is basically their comments are exactly what we've been talking about. It was all around the rapid expansion of data centers and the hyperscalers, and essentially they're looking at, they've got 37 data centers at the moment. They're going out to 71, and there's just potentially $1 trillion in revenue coming. So just to go into the detail, these are some sources of Zero Hedge here for anyone who's ever visits Zero Hedge website. If you want to be bearishly inclined, that's a great website to go to. They don't ever produce anything that's mildly positive. It's not borderline sort of tinfoil hat. They do love a bad news story, but I don't like to use their charts. But this is the only one that they had a chart out very quickly, given that it was bad news. But we're looking at, annual benchmark revisions to non-farm payrolls. The last 2 years, essentially, well, pretty much the worst in history, or two of the top three. Look, that is bad for the economy. And look, we've got PPI and CPI this week as well. PPI's tonight, Wednesday night. We've got CPI on Thursday. On Thursday night, and essentially we're expecting 2.9 for CPI. So anywhere around that 3% mark is high inflation. Anything that's above that, that ends up coming in above that, is going to be an absolute disaster for equity markets. I'm genuinely surprised that we managed to maintain. Those numbers came out at 5:30. There wasn't much of a reaction. I think the what's going on is that the couple of little drip feeds of good news have come through in the energy sector and sort of the power and utility sector, and then Oracle as well. So, investors are really focusing on that. But the broader economy doing this plus inflation around 3% is textbook stagflation. Stagflation is basically the worst thing that can, worst economic condition possible pretty much for equity markets. Rising prices, softening economy. Last real example of it was in the 70s. And just to give you some historical context, essentially in that decade, and look, markets move a lot faster now. So I fully expect, almost treat it like dog years. For every decade I'm quoting, it's probably would only be about 2 to 2.5 years in current time, because the market moves at warp speed now compared to the 70s. But the average return for the S&P 500 in that decade was flat, basically. You don't even want to know what the number was, inflation adjusted. And and essentially that's versus near on 10% for the average annual return for the S&P. So it really is economic weakness without inflation is better than that. It's up, I think, up around the 2% mark on average in those sorts of economic conditions. But yeah, I would imagine we haven't really seen any inflation effects from the from Trump's tariffs, etc. So I don't really see prices having any downward pressure. And those jobs, those jobs revisions are, well, look, for those who have been watching the morning podcast for a while now, look, very coincidental that, Trump's getting exactly the numbers he wants from the BLS now. Given he fired the commissioner, he's putting in his own man, and this is probably the easiest way to get it is through this revision. This will get a second revision in January 2026, but look, the horse will have bolted by then for sure. So, I think personally, I'm not a big fan of the rate cut argument in terms of it being a one-size-fits-all solution to, broad benefiting the economy and stimulus. But the government essentially can't spend any more money because the debt's so big over there now. But I think this genuinely puts 50 basis points on the table at the next meeting, and Fed's under pressure. That revision is massive. We basically had a first headline negative number for June in payrolls. Anything below that 2.9 in CPI is just going to, and then we're going to have to balance this up here with the joy of rate cuts. 50 basis points is like an emergency move, and realistically, and we had two major US investment banks last night, Goldman Sachs and JP Morgan. JP Morgan are always on the bearish side. Essentially, be careful what you wish for. Essentially, if 50 basis points is on the table, but they're recommending to their clients to sell into that, and they, I think JP Morgan was predicting anywhere up to 16% decline, or anywhere up to 20% decline, basically from after that rate cut. So, and look, rate cuts, because the economy is weakening, is not a reason to buy, essentially. However, the reasons to buy is this rapid expansion of data centers. So, Nvidia, Broadcom, Google, and Oracle particularly rallied significantly in the aftermarket. So Oracle's only up 1.27 here. I'll just do a quick check here now, because the last time, obviously it's been it's been a pretty volatile aftermarket, but we still actually are maintaining up 26% as at 8:10 here in the morning, it's really filtered through into the other major hyperscalers. So there were some really interesting quotes from the CEO there this morning, which I'm very much of the on the hyperscaling and data center and AI bandwagon. We just recently did quite a large and very popular and structured investment, as well as it's one of our high conviction themes here at MPC. But here are the key quotes. We expect multi-cloud revenue to grow substantially every quarter for several years as we deliver another 37 data centers to our 3 hyperscaler partners, to a total of 71. Second key quote, over the next few months, we expect to sign up several additional multi-billion dollar customers, and RPO is likely to exceed $500 billion. So, and you can obviously understand why they're up 27 odd percent. We're talking $500 billion rev number, like signings and etc. Oracle and Google were our 2 picks in that hyperscaling space. And I believe basically we've had that structured investment on for 9 days now. That's Google's up 15 and Oracle's up now 30%. So going well so far. It'd be interesting to sort of see, where basically where this market's going to be tomorrow, because we're going to have to weigh up that weak economy and the inflation data versus the biggest companies in the index. As you can see here, these squares are relative to the market cap value of the companies. So the bigger the square, the bigger the company, and all the big ones are involved in this. We got the likes of Nvidia up 2% in the aftermarket. I would imagine futures, futures will be up pretty well here at the moment. Just doing a little double check here for you. Futures have jumped 0.3 in the aftermarket as well. So for the S&P 500, but countering that, the stagflation fears are going to be horrific for the rest of this, essentially. So take out these guys. The other 70% of the index is probably not going to perform particularly well. Apple had their iPhone 17. Look, I'm not going to call it a launch. I'm going to call it a repost, essentially. Same old crap. New camera, new processor, software update. At this point, it's actually just a joke how much Apple's just phoning it in. Excuse the pun, sorry. But I don't even know why they bother sending Tim Cook anymore, to be brutally honest. He's probably just sent out a press, out a press statement. Look, I think iPhone, which is 50 to 55% of Apple's revenue, and obviously is the sticky part of, getting people on your ecosystem and using your subscription products. I think we're one leap in technology away from Apple potentially having a horrible Kodak or BlackBerry style moment. They had upgrades to the screens and things like that. I mean, we're talking, it's been a decade or more than a decade now. It's such a disappointing event every single time, and they tagged it ore dropping, and disappointing is probably the only word really that can be used. But two positive announcements, obviously, Oracle here. Revenue up 12, gross profit at a 67% margin. Operating profit, 29% margin. Net profit, 20% margin. They're keeping their costs down. And look, this pipe coming in is just going to get bigger and bigger. I mean, look at this, cloud up nearly 30% there, and they're expecting more and more contracts. So, Oracle was the poster boy of the .com bubble, and it took like 15 to 17 odd years to get back to flat. But look, these guys I've obviously learned their lesson, but these guys are now killing it. So it'll be interesting to to see if we can hold those gains tomorrow and how much of that positivity flows through, depending on the on the result of the PPI number. I would say that really for me wraps up earnings for the week, I've got to say. We don't really have anything until the ECB rate decision, and the PPI and CPI, they're going to be the main focuses. But look, I wouldn't expect anything to eclipse that result from Oracle. that is just categorically outstanding. That particular thematic in the market. Look, we're here at NPC. We've got stores of value, gold, silver as one high conviction, defence stocks as another, and particularly European defence stocks and this data center expansion as our three high conviction themes for the next 2 to 3 years. And each of them are all playing out quite nicely here at the moment. We even had Morgan Stanley upgrading the European defence sector last night and initiating coverage of quite a few of the European names, Leonardo, Thales, Rheinmetall, etc., and saying that defence spending and budgets are going to increase more than people are expecting at the moment. And what they're expecting at the moment is $1 trillion extra dollars, per annum over the next few years. So it's going to be a big space. The money's got to be spent somewhere, and they're going to spend it at home with their local, with their local companies, given it's government spending. So and Trump starts to defund NATO. So again, another really positive theme. But as I say, very contrasting. Because I don't think the rest of the market's going to go very well. I think you need to gravitate towards those high conviction themes with very, very definite, tailwinds and catalysts, because the rest of the market it does not bode well. Stagflation conditions are essentially a disaster, and fingers crossed, but we don't get the kind of moves we got back in the 70s where the market literally halved. I can't see that happening. And markets do, as I said, pre-2009, if the market dropped significantly or above 20%, it took 500-600 days to recover. It only takes about 130 days, 120, 130 days now. Market is much faster. But it's still not good overall economic conditions. And no matter how good companies are going, I go back to flagging Salesforce's commentary on their customers scaling back their AI spend. I would expect there to be some form of concern in the market. We can't be held up by just a few stocks forever. And I would definitely warrant caution, particularly in this seasonal weakness period. But yeah, sorry to end on a negative note. If you feel like being cheered up, make sure you go and have a look at those. Oracle numbers. Look, I think that pretty much wraps up. Wraps up the morning call for this morning. Quickly, commodities. Gold and silver drifted. I think with 50 basis points on the table, that's probably a healthy pullback overall. The US dollar was up 0.3. We are looking at a potential government shutdown towards the end of the month. I wrote an article yesterday. You can catch it on all of our socials about why I don't remotely think the run in gold and silver is over. There's been a lot of talk about it in media agencies in Australia in particular. It is in the top three best 2-year rallies for gold in history. Again, harking back to the 1970s was the best one. We're up 80% over the last 2 years. In the 70s, it went up 400%. I'm not saying that's going to happen either, but and the gold-silver ratio at the moment is at a point like near 90, where it's only spent 2% of the total time in the last 50 years, which is roughly about sort of 7 odd months, with silver being this cheap. And and stagflationary environments do see a flock back to real assets like gold and silver as well, and commodities. I'd expect that run to continue, particularly with the US debt, government shutdowns being threatened, etc. So apologies for it being a bit of a long one this morning, but there was a lot to digest. But yeah, I would be a little bit on high alert for these inflation numbers for the next couple of days. And again, as I've been saying over the last week or so, probably warrants, go through your portfolios, have a bit of a look through. Anything you're not loving, just cut it. As always, this is general advice. Doesn't take into account your personal circumstances, but I would say that any positions you're not feeling, particularly in love with, I think cash is far more valuable, just in case you can buy the dip, because it'll be a great opportunity. Anyway, we will speak again tomorrow. Thanks for listening. Catch you later.